So I think last week we saw on call options. So this time we'll focus more on put options, but the basic concept is same. So let's look at some of the concepts on options. So like what are options? An option is basically a right to buy a stock or any other asset. It is used in other assets also at a specific price by a specified time. So two parameters are there, price and the time. The time varies, like it could be like 1 week option, 1 month option. The beauty in US market is it goes up to almost 2 years. Whereas unfortunately, recently when I was in India, I was trying to open an account there with a brokerage, and then I was checking with my friends how is options there, because I started options in 90s from India only. When they started options in the early 90s, unfortunately, it looks like it has not progressed much. Almost after 3 decades, they don't have liquidity beyond 3 months. I checked last week also through ICICI Direct. The liquidity is only, even for great companies like ITC and Tata Steel, the liquidity is there only for 3 months, which is a little surprising and sad. It didn't progress much. India has made leaps and bounds in many other areas, but looks like not in options. But US market is pretty good. Liquidity is very good, especially on the stocks that are very popular. You have up to almost two plus years. Like as of now, we have up to January 26. We have options, so almost like 2 years from now. So it has got a fixed life to a couple of years, yearly options. And they have a specific expiration date after which its value is settled between the investors and the option ceases to exist. And you have to know that one option is equivalent to 100 shares of the underlying stock. So let's look at a scenario. Trader buys one call option. Okay, this is call. It applies to put also. Same. Contract on XYZ stock. Current market price is 25 with a strike price of 30. The premium is 150 and he pays 150 for the option. On the options expiration date, if the shares are selling at 35, okay, we are assuming, okay, it may not go up to 35, but assuming that in this case it is 35, then he will make around $500 from the sale because his strike price was 30 and $5, 35 minus 30, $5 he makes into 100 shares. So he makes $500. And his cost was 150 and his effective profit is 350 on an investment of $150. So it gives a very high return. But the risk is also there. If it stays below 35, below 30, then you lose the entire premium. Your risk is limited to that 150. Okay, anyway, this is more related to call. So let's jump on to put option. Okay, so basically, a call option is when you are going for a bullish strategy, you buy a call. A put option is when you are going a little bearish on the market or on the stock, then you can go for a put option. That's at a high level. But technically, a call can also be used as a bearish strategy. A put can also be used as a bullish strategy. That we will see as part of put option. A put option is a contract giving the option the buyer the right, but not the obligation to sell or sell short a specified amount of an underlying security at a predetermined price within a specified time frame. Maybe too much of words here. To make it simple, say a put option, say for example, Apple is around 180 now. So you have Apple stock, but you are, let's say that Apple's result is coming next week and you feel that it's not going to be good and it's going to crash. So, but you don't want to sell the share also. You want to hold it for the long time because we never know how the results come out. So you can buy a put. Say current stock price is around 180. So you buy a put for 170. The premium might be say $4 or $5. Especially around the result times, the premium also shoots up because they know that the fluctuation is there. The buyer and seller, the premium goes up. So you buy that put option for 170 at $5 premium. So you pay $500, and it's basically like you're getting an insurance. So what happens? Scenario: if Apple comes out with good results and its prices goes to 200 or 210, then you are good. Your put option will expire worthless. That $500 you paid as insurance is gone because you didn't meet with an accident, right? So it is gone. So, but your Apple makes some money. It has now gone up from 180 to say 200, $2,000 you made on that. And the other scenario, if it stays around the same price, which is rare, normally after results, either this momentum stocks either goes up or goes down. If it stays around the same price, you still hold the stock and you lose that premium that you paid as insurance for that put option. Third scenario is if it goes down, say it crashes to 150, then you have an option. Like since you bought a put option, you have the right to deliver the shares to the other person at 170. So technically, you paid $500. If you had hold just the shares, you would have lost from 170 to 150, $2,000. Plus, of course, 180 to 170, you anyway will lose that. So instead of losing 2,000 extra dollars, you will lose now $500, the premium that you paid. And you give delivery of the stock to the other person on the owning, having the contract at 170. So basically, it can be used to protect your portfolio. You can protect your entire portfolio also. Like for example, you can, if you feel the index is going to come on some bad news, then you can sell a put option on a SPY, which is for Standard and Poor Index, or for QQQ, which is for NASDAQ. So you can sell a put on any of this and protect your portfolio. You don't want to keep selling your portfolio, buying again. So you don't want to do all those things very frequently, right? So you have a good portfolio, you keep the portfolio, but you are afraid, okay, some major event is happening and election. So something you feel that it's going to come down based on the results. So you could have a put, but you have to pay a price premium for that. Hope that concept is clear. And put options are traded on various assets like stocks, currencies, bonds, commodities, futures, and indexes. We limit ourselves to mostly stocks and index or ETFs. A put option can be contrasted with a call option, which gives the holder the right to buy. In a call option, you have the right to buy. You pay a premium. Say, just to give an example, Apple is 180, and you feel that after the result, it is going to go up. So you buy the 190 call with same $5 premium. So now if Apple goes to 210, then you have the right to ask for delivery at 180 or what did we say? 190. Stock price is 180 and you buy 190 strike with $5 premium. So you don't have to, if it goes say 200 or 210, so then you can ask for delivery of the stock at 190. The other person will deliver it, has to deliver it. Okay. The right to buy the underlying security at a specified price, either on or before the expiration date of the option contract. So that is a call option. And when do you buy put options? Investors may buy put options when they are concerned that the stock market will fall, which we discussed. That's because a put, which grants the right to sell an underlying asset at a fixed price through a predetermined time frame, will typically increase in value when the price of its underlying asset goes down. If you own a put, you will benefit from a down market, either as a short speculator or as an investor hedging losses against a long position. So you can do it in two situations. Either you want to hedge your losses against a long position, or you feel the market has gone up too much and I want to short the market. So instead of shorting a stock, which is very, very, very risky, you can use an option because you know what is your maximum loss. Imagine shorting Meta and the recent results and went up $80 on the next day. Shorting the stock, you would have lost so much of money. But with the put, at least you know, okay, I paid $1,000 for the premium. So if it goes up, then I lose my $1,000. So you know your risk beforehand. So whether you own a portfolio or you simply want to bet that the market will go down, you can benefit from buying a put option. So like what are the key takeaways on a put option? A put option is when a trader forces the sale of futures contract on the buyer for the agreed upon price. So you have the right, and the other person has got the obligation to buy the stock from you. When determining which put option to buy, consider the duration of the time, the amount of money you can allocate, and the market movement. In any option premium, there are two components. One is called as the intrinsic value of the option, and the other one is the time value. So maybe let me go into Yahoo Finance. Let me make it. Give a minute. Take Apple. So 185. And let's go into this tab, which shows the options. So now, where are we on February? Okay. So this is the nearest option for the timeline ending next Friday. Options normally end on Fridays. So this is for next Friday. So let's take this simple case, just to understand what are the types of options. So you see this color blue. So these are basically called in the money. Why? Because the stock price is around 185. And if you see, these are all below 185. Anything below 185 is already in the money. So it's called a intrinsic value. So what is the intrinsic? So if you buy a 185 call, what is the intrinsic value? Intrinsic value is 85 cents because it is already above the 185 strike price. So its intrinsic value is 85 and the rest is time value. So for example, in this case, you paid last price was 283. So out of this 83 or 85 cents is intrinsic value. Balance $2 is the time value that you pay for the next 1 week, for the next 5 days of trading. And this white ones are all out of the money because they're not, they don't have any intrinsic value. Say if you buy 187.50, the entire $1.54 is time value. We're just hoping that, okay, it's going to go up based on some parameters, results, news, and you just want to risk very little. So you just pay $150 and you expect it to go beyond 187, and then you can make some money. Okay, so there are two intrinsic, in the money and out of the money. And the more the time value, the more is going to be the premium. Say for the same 185, obvious, right? So you are having more time on your side. So here it is 283. So let's look at say 1 year down the line. It's going to be, so it's now up to June 2026, which is more than 2 years. So let's take that one. We're paying a huge time value. We're paying $35 as, okay, let's take 190. $33 as just time value because you can wait next to almost 2.5 years to see whether Apple goes beyond 190. If Apple goes to say 300, then you make a very good profit on that trade. But again, I will advise you just not to go for call option alone because unless you know the direction, it is highly risky. Okay, so because call option has got a lot of premium, especially on these momentum stocks, it's got a lot of premium. So technically, say 133, 190 means 223. So beyond 223 only, you will make some money. So till that time, you don't make any money at all. So pure call options is not a great strategy. It's a little risky strategy unless you know 100% sure that it's going to go up. which nobody knows.
Okay, do you also look at the volume in that chart, in the chart, apart from?
Yes, definitely. When you want to buy, normally this momentum stocks is not an issue. The volume will be pretty good. Say
Right.
around this 124, 137, it will get executed quickly. But there are other stocks where there may not be volume, so it will take some time for execution. But for popular stocks like this, execution is not an issue.
Yeah. Thank you.
Yeah. So duration, amount of money you can allocate, and the market movement. So in this case, if you bought it and if it doesn't go up, your entire 3,300 is gone for a toss, is a loss, right? So at least if that's a difference between an option and a stock. If you own a stock, you can wait another 5 years for it to go up. It will go up at some point of time. But with an option, your timeline is only the two years.
Yeah.
If it goes beyond within that period, you make money. Otherwise, you lose the entire thing, and you don't have any more stake in the apple. Depending on your account size and risk tolerance, some options may be too expensive for it to buy. Imagine buying an option on Meta also. That will also be very pricey. The futures contract, you have virtually unlimited loss potential. Okay, so key takeaways. When do you sell put options? Selling also, so far we saw about buying. So when do you sell? So buying a put option is a bearish strategy. The same put option can be used for a bullish strategy when you sell a put option. Selling, also called writing a put option, allows an investor to potentially own the underlying security at both a future date and a more favorable price. So let's take the case of Apple itself. So you feel you want to buy Apple, but you feel the price is little high, and you're bullish on Apple on the long term. So a kind of strategy that you can, this is a very useful strategy, provided you have the cash. Okay, so then it's a pretty good strategy. Let's say Apple came out results in January last week sometime. So let's say the next quarter results will be February, March, April. So April end it will be there. So let's say, because if you choose in between these places, the premium will not be very high. So let's go to February, March, April. So let's go to May. And let's look at put option. It should be down. Yeah. So May, we're looking at May 17. Okay, provided you have, you're interested in buying Apple at a certain price and you have the cash to take care of that. Then say Apple, you need around, let's say, so this is, so here you see in put options, the prices above 185 are all in the blue because these are all in the money. Because put option is coming down, call option is going up. So these are all in the money. So these are all already in the money. And these are out of the money. So let's say you feel you can buy Apple at around say 170 price. You are comfortable to buy Apple at 170 price. Okay, now price is now 185. So now 170, the premium is around $2.67. Or if you're comfortable to buy even at 180, okay, or say what, let's say 175. Now it is 185. You are interested in buying Apple, $10 below the current price. But we don't know whether the stock will come down $10. So either you can keep watching and buy it, that is one way, or you just sell this 180 put. Okay, although it is 180, the moment you sell the put, you get a credit of $515. So when you get a credit of $550, two things can happen. If Apple stays above 180, then you're good. You can pocket that $550 and do whatever you want with that. So you made $500 on the trade. But of course, it's not free, right? You sold that option. So basically, the brokerage will lock around $18,000 in your account. You cannot use that money for anything else. Okay. So, but still, it is not bad. Let's do a quick calculation. into 100. So you got 2.7% in a matter of 3 months, right? And annualized, it's 11%. It's still not a bad deal. You got around 11%. If Apple stays above that 180, what did we sell? 180. If it stays about 180, you still make 11% on that money. Your bank gives you what 3-4%, right? I don't know. So 11% you make on the trade. And if it goes down, then you get Apple at 175 because that other person has to give you delivery at 180, and you already have a credit of 500 which you keep to yourself. So technically, your net cost of Apple share is 175. So which is what your objective was. You wanted to own Apple. Okay. So this can be used. People with good amount of cash can use this option to buy the stock. Selling puts generates immediate portfolio income to the seller, who keeps the premium if the sold put is not exercised by the counterparty and it expires out of the money. An investor who sells put options in securities that they want to own anyway, basically want to buy anyway, will increase the chance of being profitable. So if you're determined to buy Apple, then using this strategy, you are in a win-win situation. Either you get $500 at 11% effectively, or you get Apple at 175, $10 below this price. So it's a win-win situation if you're determined to buy Apple. Note that the writer of a put option will lose money on the trade if the price of the underlying drops prior to expiration and if the option finished in the money. So if you write a put option, we'll lose money on the trade if the price of the underlying drops prior to expiration and if the option finished in the money.
What does that mean?
That's what I just copied it. I'm just thinking. So writer. So basically, writer is the seller of a put option. Will lose money. Why do you lose money on the trade? If the price of the underlying drops, Apple drops prior to expiration, and if the option finished in the money.
Use the option.
Yeah, I don't understand. Maybe I'll have to check some more. I just took it from a website, so doesn't make sense to me as of now. Put option because that is your objective, right? You want to buy the stock at a price below.
Yeah, Magesh, Shirish here. This is just basically saying, if it has a big drop, then you will be assigned the shares at that strike price, but you will be immediately in the negative.
Okay, got it. Thanks, Sirish. Okay, sometimes you get stuck. Thank you. So what it is trying to say is, okay, up to 150. Since you wrote the option, you will be given delivery at what did we say? Yeah, 180 minus, or technically your cost will be 175. But if it drops significantly, then you are still at loss, right? So if it drops to 150, then you are still at sitting on you will be given effective delivery at 180 minus 175 is your cost. And if the price drops to 150, you are sitting at $2,500 loss on the stock. Got it? Clear for that? I'll pause for a minute. Yeah, I know it's suddenly I also lost track of that. You are planning to buy the stock anyway, you will get it at 175 effective cost. But if the stock drops to 150, then you will have the stock, so and you will be sitting on a little on the loss. That is what it says, underlying drops prior to expiration. After the expiration, then anyway you would have got the stock, and then it either goes up or goes down. Takeaways. Put options give us the right to sell shares at a premium. So it gives you the right to, you can sell a share basically, you're shorting and you get a premium collector credit. Buying a put is a bearish strategy. Selling a put is a bullish strategy. And longer dated puts will have higher premium value. That applies to both calls and puts. The longer you go, we saw, right, the case of Apple showing a premium of $33. Okay, so that is going to be pretty high, and you need to be right on the direction to make that money. I'll take a quick pause here and see whether you have any questions. If not, then yeah, I'm sure somebody will have questions. Otherwise, we'll take a small topic related to this.
So this is where in the call option, this is opposite, right? Because the put is buying a put is bearish, whereas buying a call is bullish, right?
Yeah, that's right.
Okay. And also, like in the Apple, for example, you said 180 right now. You put the option for 175. No, you said about 150. If you go to 150, you're in negative stuff, right? But however, you don't have to wait, right? You can always exercise it, right? If you think whatever, so you can.
If you're selling a put, then you don't have the right to exercise.
No?
It's only the other person who's got the right to exercise.
Oh, I see. Oh.
Yeah. Whenever you buy a call or put, then you have the right to exercise. When you sell a put or call, you have only the obligation. The other person has got the right to exercise.
Oh, I see.
But I think maybe what you can do, right, is you can buy it back, right? So if you, let's say you sold the put for $5 and price started falling, now it's worth $6, and you think it might continue and you don't want to take the risk, so you just pay a little bit more and you buy the put. So you end you're basically closing the trade.
Right, exactly. For in this case, like what Shirish says, if it starts dropping to say now to 185, 180, then you suddenly feel okay, maybe you don't want to own Apple. Then this would have gone say $5 to $7, $7 or $8 by that time. So then you're not comfortable to own Apple because of some bad news. Then what you can do is you can just buy the call, put a buy trade, buy to close. It's called as buy to close. And then buy the put at $8 and close your trade. You had an open position, right? Initially, you had to buy, sell to open. You had sell to open. Now you buy to close and close that. So effectively, you would have made $300 loss on the trade.
Right.
Okay, that is an option.
That's true.
I think there's a question in the chat. Yeah.
Whereas in the case of call option, right? Sell to call, then you need to have a share. You can do only by covered call, right?
Come again.
In the case of sell to open for call option instead of put, you need to own a share, right? That becomes a covered call or something.
Right. Exactly. That becomes like a covered call.
Okay.
So anyway, think about it. I think timing wise we're good. We finished in 30 minutes on the put option. I don't know why call option took an hour last week.
Yeah.
So
Can you Magesh, I missed the call option. Can you go through a little bit the highlights?
That's what I was about to say. I'm sure most of the people here were not there in the last week's session. So I can just go through call option. Then any questions on call and put, we can jointly review that. Okay.
Thank you.
Anybody? I think only a couple of you were there in the last session. Who was there in the last session from this? I don't think so.
Yeah, myself, Pradeep.
Oh, Pradeep was there. Okay, for you it will be like a refresher. Okay.
I was Prerak.
Sorry?
Prerak was there. I am there. I was there.
Oh, okay. So let's review the call option side also. That way people have a complete picture. Okay, so call option we discussed is a contract between a buyer and a seller to purchase certain stock at a certain price up until a defined expiration date. The buyer of the call, always the buyer has the right, either of a call or a put. The buyer of the call has a right, not the obligation to exercise the call and purchase the stocks. On the other hand, the seller of the call has the obligation and not the right to deliver the stock if assigned by the buyer. Okay. So when do you buy calls? It's kind of just opposite of puts. Buying a call can be used for speculation. Buying a call is a bullish strategy. For example, take companies that have product launches occurring around the same time every year. We know Apple comes out with a product launch around August time frame. And you feel that it's this time it's going to be good with some lot of features and the stock will go up. So in that case, you can buy a call option on Apple around that product launch. And if you're right, it will go up. And if you're not, you lose that premium. Okay, so that is one way you can use around quarterly reserves product launches. But again, caution, warning, the premiums will be very high. So you need to be right on the direction. I have tried those things before, then I have stopped because it's it's very difficult to predict those, what comes out of it. Nobody would have expected what happened on Meta this quarter.
Like a Halliburton, right? HAL, right?
Yeah, right. So it's very difficult to predict how these results come out. The results could be good. Yeah, Google's result was pretty good, but somehow people looked at one parameter, the ad revenues, which was coming down a little. That's it. It went down almost $10 after the results, although these results were amazing. So we never know. So not sufficient money to buy a high price stock. Okay, Chipotle. One of my favorite, but I can never buy that. It's because of the price. It's now, I think it's 2000 plus 2300. So you can never, if you want to own a share, unless you're a millionaire, you cannot own a lot of shares of Chipotle. So one way to play around is with the call option, but even call option premium is going to be pretty high. So the best way I do in those cases is doing a spread, which we will not discuss today. We will do in a future session on call spreads and put spreads, how that can be used effectively. That is much more safer because you limit your losses further. You buy a call and then sell a call against it. You do both the sides, different strike prices. Anyway, let's not go into the details now. We will cover in a future session. So to buy 2 shares of Chipotle, you will need, at this price I'm talking of, 3064. But with this money, you can buy one option of Chipotle with a suitable strike price with an underlying ownership of 100 shares of Chipotle. So technically, with a call option, instead of owning 2 shares, you have you own an underlying 100 shares of Chipotle if you buy a contract, because one contract is equal to 100 shares. So buying a call, key takeaways: call option give us a right to buy shares. It's a bullish strategy. Unlimited profit potential. Yeah, if it goes up. Imagine somebody bought a call on Meta. Wow, would have made a lot of money. Limited loss, but again, who knows, right? Limited loss because you know the risk that you are putting in the call option. And longer dated calls will have longer dated calls and will have higher premiums. So when do you sell calls? So buying a call is a bullish strategy. Selling a call is a kind of little bearish strategy. So you sell a call when you feel that the stock is not going to go up. Say, for example, Apple. Apple is 180, right? The stock price is 185. So you think that Apple will never go beyond 200 in this calendar year. Okay, let's look at Apple. Okay. So let's say, I will not say calendar year because normally, historically, the November and December month has always been a good year for US stock markets. You can say 75%. So let's not bet on that. So let's stick to September 20th. You feel that it will not go beyond 200 as of September 20th. So let's look at September 20th. Call, and let's look at a call of 200. Yeah, pretty good premium, around 875. So if you want to bet on that, but again, it could be a risky bet, who knows, right? So then you sell 200 call, you will get a credit of $880 now. Okay, but if it goes above 200, you need to give delivery of the stock to the other person because you are selling a call, no? let's assume theoretically it goes to $230 as of somewhere around September timeframe. So either you could close this. You did sell to open initially, so you could do buy to close. The premium could have shot up to $28. So you would have made a loss of $2,000 on this trade on an investment of $880. That is one possibility. Or if you waited till the end, if it is at 230, then you need to give delivery of the stock to the other person at 230. Okay, so two situations can be there. If you have the stock, you can give delivery. If you don't have the stock, then you have to buy it in the market at that point of time at $230 and give it to the other person at $200. So effectively, you make a loss of $3,000 minus a credit of $880. So roughly around $2,200 loss you make. Okay. This buying and selling at that point of time, at the end of the contract end date, you don't have worry, you don't have to do it. The exchange will do it automatically. If you wait till the end and the price is around 230, you don't have to buy the Apple stock and give it. The exchange will automatically, the brokerage will automatically buy it and then give it at the closing price on the last day. Okay, so that is the risk of selling a call or a put.
The call also, your money will be held by the brokerage firm, right?
Yeah, correct. Like for example, you sold this, what did we sell? 200, right? So 200. I think if I'm right, if you have margin trading, they hold 25% or 30%. It varies. Sometimes for speculative stocks, it could go up. So let's take, say, 30% in this case. 30 for $200, it will come to around $6,000. They will block $6,000 in your account for that trade, and you would have got a credit of $800. So your return will be pretty good if it stays lower. Just let's look at the returns. But you have the risk, like if it goes higher, then you have the risk of buying and selling. Buying at $230 and selling at $200. So in this case, let's say look at 880. Okay, so let's say they block 30%. Normally it's around 25 for, let's take 30%, 6,000. So if it stays below 200, you are making 14.6%, which is 8 months. Okay, so for a year, it will be around 20% returns.
Yeah.
Yeah, which is pretty good. You can play around an option, but yeah, you have to realize the risk also. Like in this case, if it goes to Steam case, but if it doesn't go, then you're good. If it goes to $230, then you have some risk in that trade. Both new and seasoned, did we read this? Yeah, okay. Use short calls to boost their income, but more often than not, do so when the call is covered. This is a very good strategy. Okay, covered call. Let's look at, I don't know, some of you might have seen my videos. I focus more on this covered calls. Let's take Google, recent one. Not many people have seen that. I see only 30 views. So let's look at this. Okay, just look at the fundamentals of Google. I think on Friday it was ranging between 137 to 141. Where did it close finally? Check that. Oh, not bad. It went up 142 plus. It went, it was in a 136 low range. Okay. But the previous day, only from the results, it came down from 152 to almost 140, and then it shot up. Good. So these are good opportunities to buy. Like the results were good, but it went down on some little parameter. Yeah, every quarter it may not be perfect. Ad revenue could have been a little lower for some reason which we don't know. I'm sure they will figure a way out to increase it. So fundamentals, it's a 307 billion revenue company, and it's still growing at more than 10% with a forward P/E of 20. Total revenue increased. This is the last quarter. Total revenue increased 9.36% since last year, year over year, and increased 12.34% last quarter. A big company like this increasing at this level is amazing. Net income increased 23% since last year and increased 5.07% since last quarter. EPS increased 27.28% since last year. Maybe some layoffs also would have helped them in the bottom line, and held flat since last quarter. Expected EPS growth 3 to 5 years is around 35%. This is not my prediction. I took it from Zacks. I don't know. I mean, sometimes I just put something from the analysts. This thing, yeah, it looks pretty high, but I don't know. Maybe AA could drive it. Price target for a year's time from now is around 170, which is very reasonable price target. Around 20% return in a year's time. Okay, and this is technicals. If you see the video, I would have gone through the technicals. You can go through the video later. So basically, it's got a good drop now and a good time to enter. The technical indicators like MACD and the candlesticks were all pointing to an up move in the medium term at least. So it looks good. And this is the trade that I proposed. Basically, you buy it. This is a covered call strategy. This is a very nice strategy, especially if you want to own the stock. And you are limiting your profit potential to the strike price, 170. But if you structure it in such a way, I don't expect Google to go like Meta to 300 or something like that. Pretty rare scenario. So if you structure it with a nice strike price, then you get a premium for that. You got a premium of $10 or $11 here, and that will reduce your cost also. So your effective cost now comes to 130. So technically, when you do this covered call strategy, till Google goes till 130, you don't make any loss. Only below 130, then you might make some loss on that. Okay, so but you're capping your profit potential at 170. Okay, beyond 170, what we need to do, we have to, since we sold the call, we have to give delivery of this stock to the other person. Okay, and maximum gain in this case is $4,000 because your cost is now 130 and you have to give delivery at 170. So $4,000. Maximum loss, don't get scared. That is if Google goes to zero. I don't expect Google to go to zero, so we are good. Let's look at the profit potential. I think I have the same.
So,
yeah.
So this is the covered call, right? For that,
right. Yeah.
This is sell to open covered call. So under those, you need to have some share to sell it, right?
Yeah, you can buy it as a covered call strategy itself. You buy a stock. This is the trade from Fidelity. Buy 100 shares of stock. If you have a stock already, then you have to do only the second portion.
Right, that's right. Okay.
But if you don't have the stock, then you do it like it's called as either buy and write or covered call strategy. You basically buy the stock and sell a call against it.
Okay, so you buy it whatever 140 or whatever. No?
Yeah.
Then, but in this case, no, you don't have to wait for the expiration date, right? If you see a profit, you can exercise it, right?
Right. Yeah, but you say, for example, we are in February, right? Say by May, Google goes to say 180 or something. Then technically you don't have to wait till that what is the time frame? June 2025. But the problem is you may not realize that full maximum $4,000 profit.
Right.
Because the time value will be there. No, the premium will be still high. It has got, this will have an intrinsic value and a time value. So your profit, say, could be around $2,000. But if I'm happy to take the $2,000 in 3-4 months time, I might take it and go off and do another trade. Why should I wait till the end to get that $4,000, right? Let me, instead of waiting 14-15 months and get $4,000, if I get $2,000 in the next 4 months, 4-5 months, I'll just take the $2,000 and move on.
Yeah, exactly.
That
It
is,
could go up or down, right? Yeah.
yeah, right.
Mhm.
So that way, it's got a lot of advantages. So now in this case, let's look at the profit potential. We saw 141 minus credit 1,100. The reason I put June 2026 is I don't know. I would prefer, I will do January if I'm doing in my IRA account, but I don't know what people are doing in there. They could be doing the regular account. So if you put a January, then it will be a short-term capital gains. You will end up paying more taxes on your on the profit. It will be taxed at your regular income level. So
if it is a retirement, like a real like IRA account, right? If you have a profit or loss, so it doesn't matter, right? You don't have to.
Come again.
No, if suppose in the IRA account, right, for own, your self-managed IRA account. Suppose if you lose something, you can't say capital loss or something like that, right?
Yeah, that's what I was saying. In an IRA account, if you're doing in your SASF IRA account or your traditional IRA account or anything else, you don't have to bother about the capital gains. There's no no capital gains, no capital losses. You don't pay any taxes on that. But if you do in your regular trading account, not an IRA one, then if I put it for January, if you make a profit, then you have to pay at your regular income tax level. So that is the reason. I try to do this mostly on my IRA accounts. So that's why I try to do it a little later, like June. So between Jan and June, there's nothing else. So even if somebody is doing this in a regular account, $4,000 profit, there will be limited to the long-term capital gains, which is I think is 15% now. So you can reduce on the taxes.
Yeah, thank you.
Yeah. So this is just a profit potential sheet. So your net cost is 13,000, and there's no dividend in this case. And if the price goes above 170, then your profit potential is 30%. Over a period of 15, how many months? Yeah, 15 months, which is not bad, right? Where do we get 30%? But of course, if it stays below 170, still it could be advantageous also in the sense like, say we sold a strike at 170 and you bought it at 141. If it stays at somewhere 165, 160, still you are good. You have made some profit. You don't have to give delivery of the shares. You can still hold the Google and sell another call for the next year, right? So that is also an option. So as long as it doesn't go below 130, you are making a profit in this trade. 130 is a very, very conservative price. I don't think Google will go down drastically below 130 in the next 1 year, unless there are some exceptionally bad news in the economy, which I don't think so. Okay, so that is an advantage of covered call.
Again, in one of your, I think slide 3, where the technical analysis, I think that's the one from Fidelity, right? That's what you mentioned to me, right?
Yeah, this is from Fidelity.
That like, how do you suppose? What are the key things people look at? MACD, then RSI, or what's the other one? The support and resistance. What do we see in that? Like support and resistance.
Support and resistance is your lines that you draw based on the price patterns, right? If it is going in a
is this the red one at the top? No.
Oh yeah, that's a 200-day moving average.
Okay.
Now, normally, historically, technical analysis, the 200-day moving average is a strong support for any stock. If you see this, it has been going up and getting something around now.
Right.
Have the windows, I put the chart. Okay. So if you see that it's been the last 1 year after it crossed this 200-day moving average,
Right.
it has always been, whenever it falls, it has been getting support around that level. That will 200-day moving average technically is a very strong support level for a stock. So on that premises, you can go and safely buy around 200-day moving average, but exceptions are always there. You see this on this side, it went below, but it came back up.
I see.
Okay.
So that's just the red line is was sort of
Yeah.
a support.
Maybe I can log into that also. Yeah, the red line is the 200-day moving average. And the others, these are all like, there are so many indicators, but I stick to a few of them. It's not possible to go and look at everything manually. So I focus mostly on MACD, relative strength index, RSI, and stochastics. And this one also I added recently, some momentum oscillator.
Maybe one session, maybe you can walk through this technical analysis a little bit more.
Yeah, sure. We can do that as a separate session. Give me 1 minute. Let's see. Okay. So this one we were saying, looking at this, yeah, and then I don't think this is a disclaimer. So, okay. So whatever I say, still do your own due diligence.
Yeah.
And if you need a financial advisor, get their help. Or maybe hopefully I'll become a financial advisor in 2 months' time, then I can also guide you. Any questions on call options, put options?
Good. But thank you very much, Miguel. Really appreciate it. Yeah.
Sure, yeah. So I think now it's good actually, since we finished that earlier, we could do call option also. And yeah, I think most of you were not able to attend, right? So it's good that you covered both call and put.
And then next time you probably do some hedging also, right? So that the call.
The hedging, your call spreads you're talking of, right?
Huh? Yeah.
You're talking of call spreads?
Yes.
Yeah, okay. I can do spreads and hopefully next week. And maybe a technical analysis after that.
Is it hedging? Is a call spread that another buzzword or?
Not necessarily. Hedging can be used in different ways. Even buying a put option is a kind of a hedging, right? So that is also your hedging against your portfolio or something. So it can be, yeah, it can be in useful in different ways. Like whether you hedge with a put option, that also can be said as a hedging tool, or yeah, put option or call spread also will limit your premium loss.
Right.
So that also can be is technically a hedging option.
Right. Yeah.
And hopefully feel free to go into this. I think you all must have seen those videos. I don't know whether you would have seen all the videos. So you can, okay. Let's hold on.
I'm in meeting, yes.
Hold on. I think it's time. Yeah, if you go to the YouTube channel, you will see a bunch of videos there. Just I won't go into the details. So Google is a recent one. This is also a very good stock Square. It's a low price stock around 65 something, and a good covered call can give you a very good returns around same 30% with less downward risk, right? It is only a $60 stock. I'm sure Square, most of you would have heard that's the payment gateway. And Verizon is a solid dividend paying stock. And yeah, even though the stock price doesn't move, you will still get 5% dividend. And selling a call will get you another 4, 5, 6%. So totally you will make 10%, even if the stock doesn't move up much. So that's a pretty good. These are dividend players. Verizon has every year they increase the dividend for the last 2 decades or more. These are more like economy play. FedEx, it's hopefully we expect the economy to improve. So based on that, that should go up. Same with the United Airlines. Your risk is a little less because you do a covered call strategy, and the prices are pretty attractive now. This is also a dividend player, BMY, Bristol Myers, and say if you get around 4% dividend, and with a covered call you get 10%, and yeah, it is technically at a very good spot. I think it should have gone up. Let me recheck. Because normally I look at the technical analysis also and then buy. So
you have a video on anything on the technical analysis on this on a
you mean just a technical analysis? No, I have not done anything.
Okay, that'll be cool. Yeah.
Right.
Like before you do anything, right? You want to look at it, do some homework, right?
Right.
Right, rather than shooting in the dark, right? Yeah. For example, here, yeah. See, right now the price is too high, right? Based on the line on the SPY, right?
Yeah.
Okay.
So yeah, sorry, to BMY.
And the other one, the previous one, SPY, SPY.
Yeah, the BMY is still around the same price level only, 48, where I think 50, 48, 50 around that time I recommended. I think this should also start moving up.
Yeah, this one. Yeah, for example, this one, right, is too. How do you when you look at it? The red line, that's your moving average of 200, right? Right now it looks like now so high. So would you like should we would we expect hopefully we can put some put call for the price to go down or something like that based on historical oscillation?
You saying that price will go down?
Yeah.
See, but you can never see. Look at this place. This place also things are high. What if you put a if you sold a call option or you did a what is another
The put option.
yeah, then you would have lost money because it still went up.
Yeah.
So sometimes it's the technicals will give you some guideline, but you have to take into parameters a lot of things like economy, interest rate cuts, job market, so many other economic factors, right? So economy has been doing pretty decently well with a high interest rate. So this keeps moving, and they're expecting a rate cut, which should be coming sometime this year, around May time. Then that is going to be additional kind of a bottom line, right? It's going to straightly impact the bottom line. So we never know if things looking good from the economy perspective. From Fed perspective, they kind of achieved a soft landing without bringing in a recession. We didn't have a recession this time. Right. So
I don't know, one thing whether you notice, like, every time, Miss, when doing the earnings session, the prices, you see the Wall Street goes up, everything, right? When all the earnings are down, everything's calm, right? It start going down. Have you seen that pattern? The last, at least for 1 year, I've been looking at, instead of, it goes up and then boom,
No, after the earning, you were saying things are a little
Yeah, after the earnings, yeah.
Yeah, that is always there. Every quarter, things gets heated up. The speculators come in betting on the stocks up and down. And after the earnings, the next 1 or 2 months, it will be little quieter.
Yeah.
And then again, it will start after 2 months. Right. So this one was a good catch. I think that's where I started. Then in between, I stopped creating the videos. My South Brunswick people will know why. So where was that? I wanted to show this one. This one was pretty good. Like October 2022, Google was around 95. That was a good catch. Like I wish I did more videos after that. So this one from 95, 90, 95, it's now almost 50% returns.
Mhm.
This call option is also videos there. Anybody wants to review that, you can review that. I think all of you know more than this basics of stock investing, but if anybody are new to stock investing, then you can look at this video. And if you're new to setting up a brokerage account, then definitely you can look at this video also. This is based on Fidelity. Okay, sounds good. Any questions? Good. I think we are right on time. Unless we have some questions, we can spend next 10 minutes on questions, or we could wind up the call. Any questions? Hi, Kiran.
Magesh, could you send a link of those two videos, because I'm pretty new to all this, and I'm trying to still make sense of what you spoke.
Okay.
The what you initially you said, right? Those if you are new, if you could send a link of those videos, I'd really appreciate it.
Sure. What I'll do, I'll post it out here, this chat, and the link, so you could directly access where all the videos will be there. Okay.
Okay, sure.
I'm
Thanks.
posting-
And also one more question. I'm planning to, join Middlesex College for learning about this. So, which would be a good, what should I join? Because I want to learn about this, but I have zero knowledge about all this. So,
Do they
what
have
is the best
specific courses
course?
for that? Do they have specific courses?
I don't know. I know they have
Do-
something with finance.
Do one thing, there will be email ID, right? Or you can call them and ask that you are interested in this topic. I'm sure they will have some courses. Ask for
Okay.
what courses they have. Once you have those courses, send it to me and then we can discuss. Because
Okay,
I
sure.
also don't know what courses they have. Once they have, once you have the list of courses, then we can.
Okay, sure. Thank you.
Magesh,
Thank you.
Magesh, that link you put it in for some reason, oops, you don't have permission to view this page or something like that.
So it should, it's a,
Switch account or return to studio.
oh, okay. It's going to studio. Is that? Because I'm in this account.
Maybe some password, yeah.
Yeah, no, not. I think, yeah. Should go to this. Sure. It's the last video then. Just give. I have too many sessions open that makes the system slow. I'll close this one. This should work. I'm posting a new one. You can try that and see whether that works.
Let me see.
Oh, again, it says studio. I don't know why studio.
Wait, did you put it in again?
But that looks like the same like the other one.
No, it's just the old one. No, we
Yeah.
don't have.
Magesh, you can go to your YouTube channel and we can watch it. Actually. That's what I.
Yeah.
Yeah.
Hello.
Yeah. Yeah. This one should work. I'm putting it this. Touch this one. This should work. Does it work? The latest one?
No, let me cut it.
In the meantime, any other questions? I think we are to be clear, right? Yeah. It's not
You,
understanding the concept is not difficult, but the application, yeah. takes
and
time.
now, oh, no. Wait, you put a new one, you said?
Hmm.
Oh, yeah, I see that. Yeah, it does. Yeah, it works. Great, thank you. Yeah,
Okay, okay.
yeah, it's fine now.
So I think Jyotsna, you asked, right? So you can use that link, and all the videos will also be there. You can take a look.
Yeah.
Okay, sounds good. So if nothing else, we can close the call. Have a great Sunday.
Thank you.
And,
Thank you.
yeah,
Thank you so
enjoy your
much.
weekend.
Thank you
Yeah,
so
thank
much.
you.
Thank you.
Very much.
I appreciate it.
Thank you.
Thanks.
Bye.